Finally, another protocol video. Welcome to another video. My name is Kügi, and as always, I try to provide you with data and insights so that you can make smart decisions for yourself. Today, I finally do another deep dive and explanation video about a DeFi protocol. Been some time, so I'm really glad to do that. Let's see what we got. The protocol I'm talking about today, or want to talk about, is basedAssets. It's a new protocol. It's not even on mainnet yet. It's still on testnet. It will be launched on Base. At least it's on Base Sequoia currently. Not sure when you watch this video, but when I do the video, it's not on mainnet yet. Maybe a bit about the usual disclaimer: no financial advice, just educational purposes, and why I do the video. I don't get money for it or anything, so I can say whatever I want about the system, which is nice. I do it because I follow them for some time now, because I think the protocol that they are trying to build is pretty nice and interesting, and they say that they are feature complete, and I reached out on Twitter or X for people, if someone wants to look into the protocol, also look into the code before the launch, because they need reviews and would love someone to talk about. And I can't resist to get sneak peeks into code. And so I said, like, why not? I like to do such videos. I like to do some such explanation stuff. So why not? So I got a bit of insights, and now try to do that video. The stuff I talk about is mainly from the white paper, but a few things I double checked with the code and also clarified with the code there to see what's actually done. So that's about that. I will link the page and everything in the description. With that said, what's the plan for today? First, quickly talk about who they are, who is basedAssets, what they build, then about the stability and pros and cons of the system. One important thing to note, today this video will not be about how the normal end user will use the system. This will be more deep dive in the technical side, in the tokenomic side, in the mechanisms from the system. And I will do a separate video where I look into what end users can do with this system. Because in my opinion, there is a strong difference between what pro users or what experienced users and what stuff can do with the system, and how the system engine, so to speak, works, so the stuff under the hood, and what the end users, majority of users, will see from it or use from it. And if someone just wants to use it as use the benefits of the system for the end user, seeing all the stuff under the hood might be confusing. So if you're just into using the system or the benefits of the system, the real world asset stuff, then this video is not for you. For everyone else, come along for the ride. First topic: who are basedAssets? And the answer is pretty short. We don't know. They are anonymous, and in my opinion, that's not a bad thing. It's actually pretty good, because this makes one focus on what really matters in true DeFi. Don't trust, verify. It shouldn't matter who built it. One important thing is, as far as I understand, they will launch the whole thing not upgradable. So there won't be you have to trust the protocol owner to not do a faulty upgrade or a scammy update or anything. Once the stuff is on mainnet deployed and the code is verified, everyone knows what's going on. Code is law, and there's no way that they can do any rug pull or anything, and therefore it should not matter who built it. And for me, that's also a sometimes funny thought experiment, where I say, okay, what if some evil corporation built that, or some unknown scammer built that protocol? would that make the protocol less valuable? And the other side, what if Satoshi himself or herself built that? And the thing is, if the protocol is a good DeFi protocol, the answer should always be the same, and it should not matter who built it and who do it. You should not need to trust anyone or have any trust in abilities of someone. Verify the code, verify the tokenomics, verify the mechanisms, and that should be everything that's needed. Also, they don't have a project token or anything. Maybe they will do one in the future. I guess they didn't say anything about that, but I guess that in the future there might be some governance token for stuff like listing or stuff. But right now there's nothing like that. So there's also no way of creating some hype or dumping on the community or anything. So no project token, just a protocol that provides value. So that's the who are based assets. We don't know. We should not care, in my opinion. Now, the important stuff. What did they build? They built a decentralized real-world asset system. And with that, it includes already a decentralized stablecoin. The system, the assets in the system, they call basedAssets, so for based assets, and the stablecoin is BUSD for based USD. For everyone who doesn't know what I mean by a truly decentralized real-world asset system, I did a video about real-world asset systems, and if you don't know what I'm talking about and didn't watch the video, pause now, watch the other video, come back, because it's important to understand that. For those who watched the video, just a quick reminder, because that's the graphic from the other video. And basedAssets is basically exactly such a protocol. And in my opinion, it's really close to the full pure DeFi end of the spectrum for such a protocol. And yeah, as I said back in that video, the main things that we want to focus on is liquidity and price stability, how to create tokens and how to keep them stable. So today we will look at how they did that. This is a bit of AI supported summary of the system. In short, it's a dual forge system where users deposit crypto collateral into per user forges to mint over collateralized BUSD or Oracle priced real world asset loan tokens with stability and stuff. So let's look into it. Forges. I think I need to zoom that a bit. Yeah. So here we go. The system itself, so that the core of the system, the driving engine are forges. People likely know the concept with a different name, with vaults. I also am more used to call it vaults. So sorry if I misname it sometimes, but they call it forges, I think, because in a forge you mint coins or something. But yeah, so a forge is what most of people know as a vault. Anyone can create forges, and you create multiple forges. There are two types of forges, a BUSD forge and a basedAsset forge. And a forge, just one note, the ownership of the forge is done via NFT. So if you create a forge and NFT is minted, that gets into your account and your wallet. And if you send that NFT to a different address, you transfer the ownership of this forge. How such a forge works, for everyone who doesn't know, is not used to that, you can put in collateral and then create a loan and mint with that stuff. So for the arrows, black means just the coins are locked in or put in as collateral somewhere. Green means it's minted, red means burned. So how it works here, you have BUSD forge. Allowed collaterals will most likely, I usually now say most likely and everything because it's not on mainnet yet. So that's what it looks like. On the one hand, either what they said in the white paper or what I take from the code and from the test examples and everything. Because nothing is I guess nothing is set in stone yet, and stuff might change until the launch, but I think it's pretty straightforward. So currently, most likely collaterals, USDC, is coin-backed BTC and wrapped ETH on Base. And a BUSD forge has a minimum collateral ratio of 120%. All values within the forge, even all values within the whole system, are Oracle based. So it's always the Oracle price of the thing. BUSD has an Oracle price of fixed 1. So what you do there, you put in collateral, so coins at a certain value, that's your collateral value, and you can take a loan, which means you get, the system creates the loan, the tokens that you take as loan, puts them in your address, and you have a loan open that you need to pay back. So for example, here, if you put in 120 USDC, you have a collateral value of $120, and you can take a loan of 100 BUSD. 100 BUSD worth $100, 120, so 120 collateral ratio, and you have an open loan now in the system of 100 BUSD, and you got those coins in your address and can do with them whatever you like. Within the system, as I said, always $1, and yeah, you have, as long as you have the loan open, interest rates apply. So you accumulate interest over time. When you pay back the BUSD, you have to pay back BUSD, so the principal plus interest. If you pay it back, the loan amount gets burned and the interest goes as fee into the treasury. For BUSD, there are dynamic interest rates, but we will come to that in a bit. Not a minute, but a bit. So that's how you create BUSD. Same thing, theoretically, or same concept for the basedAssets, just that you have a 150% ratio here. And USDC is not planned to be collateral for the basedAsset forge, but if you want to put stablecoin into the basedAsset forge as collateral, you can use BUSD, which increases use case for the BUSD. I guess that's why they do it. But you can also use Bitcoin or Ethereum. And here you can't mint from a basedAsset forge, you can't mint BUSD, but only those basedAssets. And those are now the real world asset tokens. So those forges create the real world asset tokens. Again, minted as loans, interest apply, no dynamic interest here. I think the base interest for the assets is 1%, the base interest for the BUSD is 0.1%. And yeah, that's the logic on how to create real world assets. So how the liquidity is provided, how the system provides functionality to create them. Forges themselves, so such mechanisms with loan, interest accumulating and everything, already create some kind of price stability, because due to the 120%, BUSD will never be in more than 20% premium, because as soon as you have a 21% premium, anyone can put 120 USDC in, mint 100 BUSD, then sell that for the 121 USDC because it's 21% premium, and therefore have 1% USDC profit. So that's already giving you a cap for the premium. And then the downside is, of course, if this price goes strong into discount, you have a strong incentive to buy back the BUSD on the market and close your loan because it's super cheap for you and you make a profit. But that's a pretty weak incentive. It can work, but if there's a strong demand, 20% is far too much for a premium for a stablecoin, and even 50% for real world asset token. Also far too much. That's why they add more stability. And okay, good focus. So there are two. It's in the code. It's one stability module, but it's basically two areas. And now this is one big pool. So this is forges are per user or multiple. Everyone can do their own forge. For the stability, there's one stability contract and one stability pool that's used for everyone. Let's start with the USD stability because it's a simpler one. Here, on the one hand, again, Oracle price, and you have instant execution. And what you can do here is you lock in or put in USDC. They stay in the USD, in the stability pool, and for the USDC you put in, you mint BUSD at Oracle price plus fee. So I think in the white paper they mentioned that the initial fee for the USD stability will be 5%, but it likely will go down over time. I guess they will start just with a 5% range, and when they see that the whole thing works as it should, the fee will go down. I will guess fee goes down to 3 and then 2%. I think 1% is a bit too low, but I don't know, we will see. What that means is, if it's 5% fee, you can take 105 USDC, put it into the stability pool, and the 5% fee goes to the treasury, 100 USDC stays in the pool, and you mint 100 BUSD. So those BUSD are backed by this, because if you create BUSD via the forge, they are backed by the collateral. Via the stability, they're directly one-to-one backed by the funds in the stability pool. Means the premium is now kept at this fee, because with 105% premium fee, 5% fee here, if BUSD goes to 6% premium, you can take 105 USDC, put it in, mint 100 BUSD, sell it for 106 USDC, and you have your 1 USDC profit. So instant arbitrage due to instant execution. So this gives a hard cap on the premium of the BUSD. And as long as there are funds in there, you can go the other way around. You can burn BUSD and receive the according USDC from the pool. That's why it can only be done as long as there are USDC in the pool. But since both are USD based stablecoins, there should not be any deviation from the price. They are prepared for such deviations. That's why this is Oracle price based. And there is a pretty smart logic in there, in my opinion, what price is calculated. So it's always the worst price. So if USDC goes into a strong discount, this does not drag the BUSD down with this execution, because if this is always exactly the Oracle price, this means the BUSD can only be 5% above the USDC price. But this takes the Oracle price, depending on the direction, the worst price for the user, best price for the system, so to speak. So it will always be, the premium will be at 1.05, so $1 plus the fee, and to the downside it will be the other side, and in the premium it's the other way around. So debagging stablecoin, stability coin there, so the USDC, will not drag BUSD down or up. It just increases the range that the stability provides. So that's that. The other side, the other direction, you burn and you receive according USDC back. Again, Oracle plus fee. So let's say we have 100 USDC in here. You could take 105 BUSD, burn it via the stability, and receive the 100 USDC out of the stability pool. With that, as long as there are funds, the discount has a hard cap, because hard cap as long as there are funds, so I call it a bit of a soft cap, but the discount is capped, and therefore the price of the BUSD will likely stay within the range of this fee, which is far better than the 120%. And yeah, if the volume and everything is good, they can reduce the fee, and if they see everything works as expected, they reduce the fee and therefore reduce or tighten the range of the BUSD, which is a good thing. A bit more complex is the asset stability. It's similar because it also works the Oracle price plus fee. It now works directly fully in the system, so there is no external stuff involved. And this one works only once per week, not instant, but once per week. Why is it, in my opinion, important that it's working once per week and not instant? Because real-world assets, Oracle moves a lot, or could move a lot. And the Oracle, on the one hand, moves a lot, but also has times where the Oracle is not moving because the market is closed. Most of the assets are closed on the weekend, some are even closed overnight. So they have no latest Oracle price, or no up-to-date Oracle price during that time. Now, if MicroStrategy has important news on the weekend, it would be wrong to tie the MicroStrategy price to the latest Oracle price from Friday. Even if you have a 5% fee or a 10% range, it could be that everyone expects MicroStrategy to pump or dump 20% on the open because it's a highly volatile asset. So traders would anticipate that. And if traders try to buy MicroStrategy up until a 20% premium because they expect a 30% pump on Monday, and the system will always burn down, have some instant, like here, instant arbitrage against the latest Oracle price, that would create a lot of system debt or system created token likely, which is not what the system wants. And therefore, it's good that this execution happens only once per week. Since an EVM has timestamps, they set the timestamp, the execution to, I think, Wednesday afternoon in UTC, which is a time where most of the exchanges worldwide are open. So you are very likely to have an up-to-date Oracle price there for the tokens, for the assets. And how it works is you can schedule conversions. Internally, it's called scheduled conversions. You can schedule a conversion either from BUSD to a BAsset or the other way around, BAsset to BUSD. You schedule conversion means you lock in the funds during the week. That's the period. At the end of the period, anyone can lock in the prices for the period that just ended. Once the prices are locked in, those prices count for, that's the Oracle price that counts for the conversion. And then anyone who locked in or scheduled a conversion before can then execute that conversion, or you can always not claim the conversion, but refund it, so cancel it. That's always, you have a cancellation fee. But so if you for some reason find out that you don't want to, you can always cancel it. But once it's locked in, so scheduled, and then the period prices are locked in, you can execute it. And when you execute it, the locked in token, the in tokens are burned. So the ones are burned and the other side is minted. This, on the one hand, creates system debt because those tokens that are minted here are kind of backed by the BUSD that got burned here. If now those values go up, that's of course creating imbalances in the system. That's why this has the fee that should, on the one hand, counter that. There are limitations to the amount that can be used here within one period. And there's also limitations how many system debt or algorithmically, so via debt created BUSD can be in the system. If that limitations are reached, on the one hand, if the ratio is too high, I think they have a goal of 20%, maximum 20% of algorithmically created BUSD in the beginning or in the white paper. Maybe they change it over time, I don't know. But if the algo ratio increases, goes up, on the one hand, this fee increases, there's a multiplier on that fee. So to reduce the effect of this on the BUSD algo ratio, there is a small burn fee on paying back loans. If BUSD goes, if the algo ratio goes above 0, and if it's too big, the algo ratio, I think at 20%, the creation, this minting, so it is stopped. So you can't go in here to save the BUSD stability and the price stability. But in my opinion, this whole thing will not, if the system works, this thing should not be used at all, in my opinion, because this is more of a backstop that provides the confidence to minters. As I said, back to the other video, decentralized minters, they need the confidence that they do this stuff of creating the real asset position and mint and sell the decentralized asset. And this system provides such a confidence because they know they can always close their positions via the asset stability at the fee. And as soon as they know that, they use that and do their arbitrage stuff to get the prices down, so the prices stay below the 5%. And the more people do that, the more likely it is that others front run this, and then the premium will not reach even 4% and stuff like that. And since those prices move all the time, it's very likely that they just, due to the fluctuation and the volatility of the assets themselves, it's likely that the traders get out in profit without ever touching the asset stability. And the only risk left there is now that people use the asset stability even if it's not needed. And then they still create system-created tokens, or algo-created tokens, or system debt, as I call it here. But it would not be necessary to create it for the system, but leads to negative effects if that's done. So basedAssets, what they did here to counter that is they created a counter feature on the asset stability, which means anyone, once this is logged in and the scheduled conversion is executed, so it's claimed, anyone can counter that conversion to say, now let's say someone put in USD, BUSD, and created MicroStrategy. Now anyone could say, I take, for example, it created one MicroStrategy here, B MicroStrategy. Now anyone could take one B MicroStrategy, send it back in, and go the other way. So send it back in, burn that B MicroStrategy again, and receive the BUSD that they send in minus a bit of a fee. So the fee stays in the treasury, but they create that. So they counted it. So now, previously, just from the scheduled conversion itself, we would have one MicroStrategy in the system that's backed by the BUSD in the system, but not going, the value of the backing here doesn't go up if MicroStrategy goes up. Since if it's countered, the MicroStrategy is out of the system again, and there is no system debt that can lead to imbalances here. So as long as this is not needed to use the asset stability, if someone needs it, they just create incentive for other users to counter it and then undo whatever they did to the system, which is a nice way to prevent misuse of the asset stability. Exactly. I think that's all. The fee, regarding the fee, they, in the white paper, they propose, or they say that they want to do different fee types for different assets. Low volatility assets will likely get a 2% fee here, so a 2% range. Medium volatility assets, 5%, so like index funds or something. And high volatility assets, they say they will do 15%. I hope that's again a starting point, and they will reduce that fee on the volatility assets or on the highly volatile assets down to 10% or even less, because 15% range is still a lot for such assets, but we will see. As I said, everything is Oracle based, so you have the Oracle. They use Pipe, which is a good choice in my opinion, to provide the prices. BUSD is the $1 fixed, but everything else, collateral prices, asset prices, are all Oracle based. And as mentioned before, you always have the system treasury that receives the fees and interest payments. So the overall system stays a net a zero sum, so to speak. Interest is not burned and stuff, fees are not burned here. It's just that if this thing and this mechanism is used and creates system debt, the treasury could burn the according funds if necessary. But best case, this is not even necessary, but if it is, it might be that the system burns funds to keep the system balance. The treasury burns the funds to keep the system balance. And that's already all that there is to understand the core, the engine and the moving part in the system. Now we just talk a bit about summary and features and everything. just to summarize, because it was pretty fast, sorry for that. But to summarize main features, you have overcollateralized forges that create BUSD and basedAssets as loans, so real-world asset tokens. Forge ownership is via NFTs. That's basically already everything you need to know about that. Additional price stability, because that gives a bit of a price stability, but additional stability comes via the USD stability, which provides an instant arbitrage in the premium, so a strong cap for the premium, and instant arbitrage in the discount case as long as the pool, the stability pool, is funded. So here again, a cap on the discount as long as it's funded. And asset stability, which provides a loose binding to the Oracle price via the weekly execution of those conversions. One thing to note is that this loose binding, I think it's also a benefit regarding regulation, because this loose binding, it ensures that the decentralized asset, the based assets, have way to move and have leeway to fluctuate around the price, and therefore it's not a direct asset or not directly connected to the asset, but more like a derivative, which might help to regarding regulations. Since it's a fully decentralized protocol, regulations are not that important for anyone using it on chain. But if this system ever grows enough that the tokens might be interesting for SECs, for central exchanges, they have a far easier time listing them if they are not directly considered as securities by regulations. But I have no idea there. I'm not a lawyer. I just think that this is a benefit. Also, one note, because I forgot it before, regarding decentralization and everything. Because once the system is deployed, it's nicely decentralized, on the chain, immutable, everything good. So unstoppable, no censorability or anything. But for most of the users to use the forges, you need a UI, because they don't use it via bots or directly via their own systems. So forges need a UI, and a UI, if it's just provided by one entity, is always an attack vector or attack surface. They kind of try to counter that by adding fees that can be paid to referrals. So the actions that you can do on a forge are like adding collateral, withdrawing collateral, taking loans, and paying back loans. So those 4 actions, they can have fees applied. For example, a 0.1% fee for providing stuff. And this fee, for these transactions, you provide a referral address. And if you provide a referral address when doing the transaction, the fee is paid at the percentage, partly to the treasury, partly to the referrer. And this part can be defined by the system. And I would expect that the system, or I hope, say it this way, I hope for the based asset to decide that they take 0.1% fee, for example, for this action, for those actions, and make 100% referral payout. So the treasury only gets funds if no referrer is added, but any UI could now add themselves as the referrer. So this gives a big incentive for anyone in the space, if the system is used and people want that and there's demand for it. Anyone in the space can create a UI, and if they create a good UI that many people use their UI to interact with the system, they get all those fees as incentives directly to their referral, because when they create a transaction, the UI can say, that's my referral address, and they use it. And anyone else, if the based assets themselves create a UI, they can use the treasury as the referrer, or no referrer, or they decide that the user themselves get the fee, and any bots or anything who interact with the system to support the system can put themselves and therefore save the fee. And the stability module, I think those will be mainly used by bots. So there is no, in my opinion, not much need for them to have incentives to be, added to some additional UI, because that's under the hood stuff that anyway bots will use, and there will be bots using that, and therefore normal manual usage is likely not even on the agenda here. So that's, in my opinion, a pretty smart move to incentivize decentralized UI too, because that would be the last attack vector, attack surface here for the system. Now, regarding safety, because this is now a nice system, a lot of functionality to create prices and also keep prices in check. What about the safety? What makes the system stable and safe? On the one hand, I mentioned a lot of them already, but yeah, liquidations, we will talk about liquidations in detail next, but that's to prevent bad debt on the forgers. The counter trade feature to prevent asset stability misuse, execution limits on asset stability to prevent misuse and creation of unhealthy system debt, as I said, with the algo limits and everything. Treasury funds can be burned. If the system debt is created, they can be burned, or they can use treasury funds to create incentives for liquidity mining or anything. There are automated circuit breakers on Oracle levels. In my opinion, they are mainly there if a token split is overlooked or anything, so that this saves the forges and not mass liquidations due to Oracle error. So that's nice. And for extreme cases, they already defined a BUSD fee, which is directly burned in case of system debt. So if case the algo ratio goes too high, then BUSD payback and USD stability burn are subject to a small BUSD fee. And you have additionally, regarding price stability, the dynamic interest on the BUSD. It's updated every 12 hours automatically, and it changes maximum 5% per update, which is good for predictability, but still you have the dynamic interest to keep the BUSD price in check. Now let's talk about liquidations. General liquidations, whenever you have such a forge or such a system with collateralization, it means if the collateral ratio goes below the minimum, you need a way to liquidate the debt so that you don't have bad debt in the system. And how they do it is not with redemptions or anything like that, but directly a liquidator can pay back. So if a forge goes into liquidation, let's say this is the forge, it has a total collateral value in the forge of this, the loan value of that. Let's pretend that this is now below the minimum collateral ratio, and now this forge is considered to be in liquidation. Anyone liquidator can now say he pays back part of the loan, doesn't have to be the full loan, just some of the loan tokens. There could be multiple loan tokens in here and multiple loans, and the liquidator pays back part of the loan. Now, every loan in this forge has a corresponding collateral value, and the corresponding collateral value is more than the loan value. So for this part of the loan, let's say this is the corresponding collateral value. You have exactly the same amount as the direct collateral, and I call the remaining collateral the excess collateral. So because you have a more than 100% collateral ratio, so you have excess collateral in the forge. Now, the liquidator, for paying back that part of the loan, they receive the corresponding collateral plus a part of the excess collateral as an incentive for doing that. And then there's another part of the excess collateral that goes to the treasury as a fee. So the owner of the forge loses, they don't have to pay back the loan anymore, so they gain the tokens that they got from the loan, but they lose the corresponding collateral for that loan and a bit more as a fee, because they should have an incentive to not put the forge into liquidation. But if it's in the liquidation, liquidator has an incentive. That's the way of doing it directly if the liquidator has the funds. This way would lead to buy pressure of the loan token, which is a good way if it's in discount or the value goes up of the loan of the real world asset. So if the B asset goes up in value because of the oracle price, forges go into liquidation, and this creates a demand, and that also helps with the price of the asset. The other way is that not the liquidator buys it or gets the token, but it directly uses treasury funds, because treasury gets fees and interest payments in those coins. So over time, likely there will be a mass of funds of the treasury, of the loan tokens, of the B assets. And the liquidator could now say they just trigger the liquidation, but the treasury funds are used. So funds from the treasury directly pay back the loan. Same logic as before, corresponding collateral, corresponding excess collateral, but this time this big part of the corresponding collateral plus part of the excess collateral goes directly back to the treasury for paying back the loan, and a small part of the excess collateral goes as incentive to the liquidator, because someone needs to trigger that liquidation. And as I said, that will likely be bots monitoring that and just getting the rewards here for liquidating the stuff. Also, one thing to note is both cases, this part of the excess collateral stays in the forge, which means that after this liquidation, there is far less loan value, also less collateral, but the collateral ratio increases from the liquidation. So it could be that the liquidator just pays back a small part of the loan, and now the forge is no longer in liquidation. So every liquidation increases the system health and stability because it increases the collateral ratio of this forge, which is also a nice side effect. Yes, so that's the liquidation mechanism. Let's go to another stability part, look at the price stability a bit more in detail. As I said before, BUSD price stability, you have the hard cap at a premium, you have the discount as long as there's funds. So you have, if you take this as the $1, you have the hard cap at the 5% right now. In the beginning, if that fee goes down, this range decreases. You have a soft cap for the discount as long as there are funds in the stability, and then you have this dynamic interest rates that kick in strongly there. The dynamic interest rates are formally defined, or they're defined via formula, and I just printed out here the values for this formula from 20%, because 20% is the absolute hard cap, even if the stability module has no coins defined, or the USDC that's in there, that's defined there, goes into complete debug, whatever. Then you have the forge, and at the 20% premium, the forge cuts in, right? At the 20% premium, it would be minus 200% interest rate. So you get paid a lot to create that. Would create system debt, but I think usually if something like that happens, they find a way to get some reasonable stability coin again, so that the price instantly goes down to the 5% again, or even 3 or 4%, whatever that will be there. So within that 5% or 3%, you have a very low negative interest on the APR. As soon as this is effective, people will likely mint and sell. So this is a very low creation of system, especially if you have a 3% range, 3% fee, and you get only 4% on the whole year APR. So that's not too bad, but it's an incentive to create more tokens, more supply to get the price down. In the other direction, if the stability is off, so the pool is empty, you would get huge interest rates if you get into strong discounts. Small discounts, 5% discount, you pay 12%, so 1% a month. Still not much, but it's an incentive to close your loan and so buy it back, pay it back. If it goes into stronger discounts, the target interest rate increases massively. As I said before, every 12 hours, maximum 5% increase. So not 5% relative to the interest rate, but 5% points. So within 12 hours, it can go from 5 to 10 to 15 to 20 and so on. But yeah, that's a strong incentive to get that back. So I think even if the stability is completely depleted, the dynamic interest is a strong incentive to not stay into a strong discount for time. So that's the USD stability. And then let's take a closer look again on the asset stability. As I said before, once per week, anyone can convert. Fee is in the range of 2 to 15% as defined in the white paper right now. And this leads to this loose coupling between based assets price and Oracle price. And as I said before, this, in my opinion, this allows a realistic trading on weekends during market close times, but it keeps the price in range over time. I sometimes call it eventual price stability. So it's not instant, but you can think about it as like this, where we have the time range with Wednesday every week, and every time on the Wednesday you have this bracket around the price, where if this is the real asset price, the base asset price can move how it wants during the week, but at the end of Wednesday, at the end of the period, it will go down within this range. As I said, usually I expect that the traders, the decentralized minters, will use that confidence to keep the price within the range, tightly within the range, during the week already, because they can do delta neutral positions and therefore profit as soon as there is a bit of a premium or a stronger premium. So it won't, maybe on the weekend. So in between here, it will likely be a bit more volatility, but during market hours, it will likely be pretty tight, or at least within the range. I'm not sure how tight, but within the range. And yeah, this gives these decentralized minters a calculable, is that the word? I don't know, backstop for their minting operations, which is exactly what such a system needs, because that's the big question for any such decentralized real world asset system, how to incentivize decentralized minters, because such a system can only work if there is a backing of real assets, because only such a backing creates the price stability. And in a decentralized system, you need decentralized users to provide this backing. The system itself can only provide the framework to allow users to do that, and to allow everyone to trust the system, so the code, but just the framework and the incentive that they do that. If this is enough incentive, I don't know. I think there is no system yet that works like that and is healthy right now. I know a system that works similar to that. No BUSD stability, but the asset stability is pretty similar. But that system had other errors in the past, which led to a really strong feedback. So I think we don't know yet if such a system really works over time, but I think it could, and it will be interesting to watch. So to summarize, and then, yeah, it's been a long video, sorry for that. Pros and cons. Pro, it's pure DeFi. It will allow 24/7 trading and borrowing for real-world assets on the blockchain. In my opinion, it has solid stability mechanisms and risk management, which is a must-have. There is no single point of failure or attack vector. Even the UI as a single point of, or a centralized attack vector or attack surface is mitigated with this referral system. They say it will be not upgradable. We will need to wait how they really do it, but so far I think they will do it like that. Sounds like they are trustworthy in that opinion and that part. so not upgradable. Team can change rules, and they have no tokens. So there is no conflict of interest between system stability and price of the token, because as soon as you have a token that's connected to the system, usually you get some conflict of interest there, and no dumping on the community or anything. So that's a big plus. In cons, same as a pro, not upgradable. So if there's a bug in there, if there's a problem, it stays in there forever. So it's important that people review the code before it goes live. And I think they said they will make it open source before putting it on mainnet. But yeah, I hope there will be enough people to review that. Also, the tokenomics need to stand the test of time. As I said, there is no proof yet that this works. In theory, it works, but yeah, there is no proof yet. No token also means no way to hand out incentives. So one big question will be how they are able to attract initial liquidity, how they attract users, how they attract the community. So far, I'm following them for months now, and it seems like, on the one hand, I think they're pretty bad at marketing. Sorry, but they didn't manage to attract a lot of community or attention yet. So I'm not sure if that changes or how to change that. There's an Oracle dependency. They depend on Oracle price from Pive. The code, the system allows to easily adapt the Oracle. So they could add extra oracles from other sources, but for now they have the dependency, and that is a dependency. I hope that they work on that to reduce that dependency and make it more decentralized or whatever over time. But we will see. I think there are areas of the system that can be improved over time, and they, in my opinion, they need to be improved. Like the whole question of what tokens will be listed. For now, or in the beginning, that's all in the hands of the owner, so of the based system team, based asset team. But maybe or hopefully they create a governance smart contract that will be the owner of the system, then where there will be some governance voting of people using the system or whatever for new coins, listings, changes in fees and stuff like that. And yeah, as before with the initial liquidity, big question will be how they will be able to attract the critical mass so that they have enough users, enough liquidity that the system can be used. Because there's not much point in having a system with $100 liquidity, which is perfectly stable at the price, but yeah, no one can actually use it for any reasonable transactions. So yes, that's it. Been a bit more than the wanted 30 minutes, but if you stayed till here, thanks for watching. Let me know what you think of the system. If you think this can stand the test of time, if you would use it, if you are interested in more videos about that, if you are interested in reviewing, I'm thinking about doing a video about code review of the system. I'm not allowed to show the code before it's officially open source, but maybe about the concept, how it's done, so what parts play together and how. Maybe that's helping. If you are interested in having a preview at the code, doing reviews beforehand, or doing also a content video about it, they reached out on Twitter. They asked for people, so just follow them on Twitter and DM them, send them a message. I guess they're happy for everyone who does something there. And with that, if you found any errors, leave a comment. If you like it, leave a comment. If you have questions, leave a comment. So see you in the next video.